Good morning, everyone, and thank you very much for the opportunity. My presentation is just going to walk you through what the transaction advisory process is, just to let you know in terms of what we look at as transaction advisors, what the regulators look at, and also what the investors look at. Firstly, why are REITs attractive, and why do people consider REITs? I think the key things really for an issuer is that it's a tax-efficient structure for investing in real estate. It's also an opportunity to gain exposure to real estate without directly owning property. So you have an investor, instead of you buying apartments, buying an apartment block, even investing in a retail center, you can actually get exposure through REITs to different sectors in ways that you can manage in terms of what you're looking for. It's also a way that provides liquidity. Again, real estate, traditionally, you have to buy the building, you have to buy the block, but REITs, you can actually buy the number of units that suits where you are in your life. And then if you want to actually exit, there are also exit mechanisms as well, instead of relying on selling the building and so on. REITs are also professionally managed. So CMA goes through a very thorough process to license a REIT manager. And once they're licensed, their sole focus is to generate returns for the REIT. So if you think about perhaps in your private life, maybe you're working full-time, but then you've got a side real estate project. How do you manage that? You know, sometimes your attention is split. So when you look at REITs and professional management, you have somebody who is focused on delivering returns for you. And lastly, it's a regulated structure. So transparency, accountability is inbuilt. So this slide sort of touches on some of the things I've already mentioned, but I look at what are the benefits to the issuer and also what are the benefits to the investors. So firstly, it's a regulated structure. So the issuer, you now have transparency and the disclosure framework of the capital markets. Think about in the real estate space, some of the scandals that we see on a regular basis. The regulated structure aims at minimizing that. It also will enable you to raise capital from institutional and retail investors. As you had mentioned, pension schemes, insurance companies have investment guidelines, and a lot of those asset classes are listed capital market structures. So if you actually want to target these schemes, you have to give them a capital structure that they can invest in. So if you come to them and say, I have this building, can you buy it? They might not say yes. They probably will say no. But if you come to them with a REIT, that's something that they will look at. For investors, it just gives you additional comfort that there's certain minimum disclosures available. And then there's also an avenue for resolution if anything goes wrong with the investment. So if you think the REIT manager is doing something wrong or they're not giving you enough information, you have the Capital Markets Authority and you have the NSC as well. Tax efficiency is a big one. So for REITs, they're exempt from income tax. So think about if you have your properties and you have your rental income, you pay your 7.5%. REITs are exempt from that. And then when you sell the assets from the REIT, they're exempt from capital gains tax and VAT. And then from an investor perspective, what that means is that those tax savings now come to you through distributions as well. And then if you're investing in a REIT that is listed on the NSC, when you're buying and selling, it's also exempt from CGT. So all those savings come directly to you. Access to liquidity, you had also mentioned this, is very important for fund managers. So these units can be listed on the NSC, or they can be listed on the USP or the OTC that NSC runs. So you have an opportunity if you're a promoter, say you have 50% in a REIT, maybe you want to sell down to 30%, you can actually slowly sell down on any of these platforms as well. So again, you don't have to own 100%, you don't have to own 0, you can actually own something in between. And for investors, you have the same benefits as well in terms of liquidity. The last one is really diversification. REITs allow you to aggregate different properties. And then for investors, this gives you exposure to perhaps asset classes you wouldn't invest in. So personally, again, if you have invested in real estate, it's likely a property, residential housing, maybe office blocks. But there are other real estate assets that perhaps you will not be able to invest in directly. Maybe logistics, maybe a student accommodation, and so on. So one thing to highlight is, as this is a regulated structure, there are setup costs that would need to be catered for by the promoter. So now the financial capacity of the promoter starts to become important. So if you look at the REITs that have come to market, those have been brought to market by institutions as well. This toolkit is working to see how to reduce those setup costs, but those setup costs are not going to disappear completely. So it's something to actually bear in mind. And the way to really look at it is to look at what are the tax savings I'm getting from this structure. So if I'm saving on the tax I would pay on rental income, if I'm saving on say CGT, if I'm selling assets from the REIT, how does that apply vis-a-vis the setup costs as well? And that's also where your REIT manager comes in and looks at what the returns are going to be going forward. Does it make financial sense? Now, when it comes to the actual transaction, one of the questions we always get as advisors is, why does it take so long to set up a REIT? And what we want to sort of walk you through and get an understanding out of today is that the different elements that go into setting up a REIT vis-a-vis, say, a normal capital markets transaction. So this tends to be broken down into 3 elements. So you've got your capital markets transaction, and that tends to be relatively straightforward. You've also got a property transaction, and then you've also got the tax transaction or the tax element. All these play into what comes into structuring and the advisory work. And depending on the REITs, where you start from, these will have different impacts. Sometimes they can be short, they can take a longer time, but these are the things that you really have to think about. So when you look at capital markets, this is like the key question is there going to be a capital raise, or are you as a promoter just looking to bring your property in and get units in return? What that means is that if there's a capital raise, you're going to have the element of engaging with investors and have the offer period. So that adds some time to your timeline. If it's just exchange of units, that's perhaps a quicker, faster way. The other question is, where is it going to be listed? Are you going to be on the main board? Are you going to be on the USP? Issuers have their preferences, investors have their preferences. So again, your structure matters. Are you raising capital? If you're raising capital, you're better off listening to what your investors want. But if you're not raising capital, maybe you can look at the USP. Investor education is also key here, and this takes up different forms. Your underlying assets, is it a sector that people understand, or is it a new sector that you also have to educate them on in terms of what that means? And then also from a REIT perspective, sometimes people sort of understand how REITs work, but they don't fully. So we attended a trustee event about a week ago, and where we were able to present what REITs do. And there also the type of questions that were coming up were very different from the type of questions fund managers ask and so on. So for investor education, that's something that is ongoing. And with RAC, that's something that we're trying to address with the NSC, but that's also key. You have to build in time to get people to understand what your asset class is and what your REIT is trying to do and the returns in that space, and also allow them to do their own research as well. And then, of course, compliance with the REIT regulations. We have to ensure that whatever is put together will meet what CMA is asking for. Now, so that's capital markets. Now we move to property. Now, the assets you have, what are they? And then the other question is, are they assets that will be of interest to other people apart from yourself? What I mean by that is sometimes there are investments you have that are sentimental to yourself, but maybe the returns are not that attractive. It's a location people don't really understand. So is that something that people will be intrigued investing in your REIT for because they want to get access to that asset? What is the real estate strategy, and also what are the projected returns? Because REITs are about scale. If you seed, like say 2 or 3 assets, what else are you going to do after that? And sometimes there is where we have a bit of a challenge, because if you look at REITs as just your exit mechanism, I have this property portfolio, I want to exit, I'll do a REIT. The question is, after you've set up the REIT, what happens after that? So that's just something to think about, and sometimes this takes a bit of time to think through. The other question is, how are these properties currently being held? Because that will also have an impact in terms of how those properties come into the REIT. So are they held directly by a company or in your name? Are they held as an LLP, LLC, trust, lease? Are there other people we need to negotiate with or get approvals from for them to move into the REITs? Again, these are questions I would have to answer. Property due diligence. Is there an issue with the title? Is there an issue with the titles around it? Is a trustee comfortable with it? Those are questions I would have to answer. And then lastly is valuation. What is it valued at? And is that a return that is attractive for the REIT? Because remember, for the income REITs, the return is key. So valuation is important, but if you have a very high valuation and the return is coming to 2-3%, it won't make sense for a REIT, because once you add the other costs, you're at near zero. So the valuation matters as well. Lastly, tax. So again, when we move the properties into the REIT, what are the tax incidences that happen? Currently, REITs are subject to stamp duty, and that's work that is ongoing, and there's been a lot of engagement on that. But you really need to understand what is the cost of moving those properties into the REIT. If you're a promoter moving your own properties into the REIT, are you exempt from CGT? So you have life insurance companies are exempt from CGT, but other companies are not. Again, that is something that is work in progress. And then when the REIT is operating, it doesn't pay income tax and CGT is exempt. So that's a benefit. But we find the current challenge is getting these properties into the REIT in an optimal manner. So when you put all these things together, capital markets, property tax, you find that you're dealing with different challenges and different elements. So really think about this. I'd recommend that on the property side, there's a lot of work you can do as an issuer before you come and acquire advisors. Like, just have an understanding what the returns are, have your financial model, and if you're the REIT manager, have that application already starting, because CMA would want the REIT manager license to come out first before you now start applying for the REIT. So these are the different elements. And again, once you think about your own real estate transactions, how long they take, add that to the capital markets transaction. This is where the timelines are. But as mentioned, there's a lot of work that's been done. On top of that, you have a lot of government agencies that are dealing with these three elements. And RAC has done a lot of work to streamline these processes. But as mentioned, there's still things which are ongoing. So when you look at the capital markets, you're engaging with CMA, NSC, sometimes IRA and RBA. And this is the work of the TA. So we manage some of these relationships. On the property side, you're looking at Ministry of Lands and Physical Planning. And then on the tax side, you've got National Treasury, KRA, and Parliament as well. But RAC has been quite instrumental in ensuring this coordination is as efficient as possible. So when it comes to lessons learned, so we've had a few REITs come to market. We've had a few that have sort of stalled along the way. And I think there's some things that potential issuers should bear in mind. So the first one really is returns. The returns have to be there. So if you're dealing with property that has a very low return, the REIT is going to struggle with if those properties aren't delivering competitive returns. So this is something that you'd really need to see. How can you increase the returns of your properties? And really that's from an operational perspective, and then think about valuation as well. And I think the key thing there is REITs value cash generated from these properties. So how much cash are you generating? How much rental income are you generating? How much OPEX are you using? So you try and minimize that as well. So that's where the professional management is key. Economies of scale. So those setup costs can be really big if you have a smaller REIT. The idea is those costs should be spread across larger real estate portfolios. So as a REIT, you can start small, but you really have to have a plan on how you will scale. Because once you get to a certain scale, you now start thinking about the operational costs. In terms of cleaning services, security, property management, you can now actually use the same team to cover 10, 20 properties as well, as opposed to just having maybe outsourcing because you have 2 or 3 properties. So economies of scale is really, really important. And if you think about your REIT management team, you don't really need to scale up significantly if you're managing 10 vis-a-vis 20 properties and things like that. So economies of scale is critical. The other thing is pipeline acquisition strategy. You have your seed assets. Where are you going to get your future assets from, and how will you pay for those future assets? So how the REIT will fund itself going forward is a question you need to have an understanding of today. So, and that's key, because if you're distributing 80% of your profit, it means that you have very little for OPEX, and it means that when you're looking to acquire property, you either have to find cash from rights issues or convincing the promoter to give you the property in exchange for units. So in other markets, REITs tend to benefit from low interest rates. So they tend to get debt to actually do their acquisition. But here, debt is quite expensive. So you're really looking at rights issues, cash, or property exchanges. So think about that. And I think there's also, you need to also educate your investors on how you will be doing the capital raise, because one of the things we've seen is that there seems to be a bit of fatigue on the investor side about the regular capital raises. So if you have a REIT, it's underperforming in terms of returns, then you come to them and you want to get more capital to acquire more properties, you now get into a cycle of, you might not even get into a cycle because you might not get in the capital, you might not grow, and if you don't grow, your returns stay the same. So you need to find a way of breaking that. So the key thing is really think about your acquisition strategy, think about economies of scale, and then think about returns. So not everything will be suitable for a REIT, but if you think about these key things and if you meet them, then it's something that you can definitely have a conversation with. RAC are also able to have meetings with you, take you through the process, and just give you a bit of guidance in terms of how you can go about it. And the other investment banks, brokers are also available to have those initial discussions as well. So that's the end of my presentation. It's just to give you a flavor of what we look at from the transaction advisory side. But I'd also say, think about some of the issues who are coming to market. They're also very open in terms of sharing information about their journey. So that could be something you could also look at.